My name is Brian Kelleher. I'm Chief Revenue Officer here at Simplify. And we've got a phenomenal panel today. So on the far left here is Paul Van Gilder. Paul is Senior Investment Officer at Michigan Employee Retirement System. Maris has been a huge user of ETFs, and Paul is a expert on ETFs, and we're delighted to have him. Next to him is Eric Balchunas. Eric is Senior ETF Analyst at Bloomberg Intelligence, as well as co-host of ETF IQ on Bloomberg TV, and host of the popular ETF-focused podcast, Trillions. He's authored several books on ETFs, including The Bogle Effect, and the ETF Institutional Toolkit.
You had it the first time.
Institutional ETF Toolkit.
No, box.
Box.
That is so important. It's got to be box, not kit. Just kidding.
And then Dave Nadig is financial futurist at VettaFi. Financial futurist is a Gen X vlogger, apparently, and blogger that has persisted till now. But Dave does a great job of writing about financial markets and trying to figure out where we're all heading with this. He is also, you've been a pundit as long as there's been ETF pundits, as have you, Eric, and is the co-author of the, now I messed up the other one.
Totally guessed.
I'm totally going to mess it up. The Comprehensive Guide to Exchange-Traded Funds, which was published by CFA Institute. Got it.
Nailed
So as long as I've been around, and as long as you guys have been around in ETFs, it seems like people have said, okay, the ETF market is mature. You know, everything that needs to be launched is probably launched, and you know, it's just kind of a race to zero. But you know, innovation is more or less dead. But you continue to see new products coming to market. Eric, you've been at the front lines of this. Like, what has your journey been in ETFs? Like, from when you started to where we are now, how has it evolved? What's changing? What's interesting and new now?
Yeah, I mean, I'm surprised every year. Some of the stuff they think of. I know when I got into ETFs, it was right around 2006. So the big ETF at the time was GLD. Everybody was like, oh, gold is finally in ETFs. And HYG was also making a name for itself, causing controversy. Can we really package junk bonds? And then it evolved into smart beta. That became a big thing. Currency hedging. Going long this, going short this, packaging up multiple things in one shot. And when I first got ETFs, I had been a mutual fund reporter for Institutional Investor. That was my first job out of college. And I did a couple other jobs, but when I finally get into Bloomberg data and got handed ETFs, having known mutual funds, I was like, wait a second. I kicked the tires on this, and I'm like, this is going to be a big deal. This is like 5 evolutionary steps beyond the mutual fund, not one. So I continue to equate the ETF to the MP3 in terms of what that did to music. I think the ETF is a similar kind of technological breakthrough, and so I dedicated my whole career to being the ETF guy at Bloomberg. And honestly, Dave had me by 10 years. I mean, he's really been around. Not in age, sorry. In intellect and in knowledge of ETFs.
Nice backpedal.
Yeah. And I used to drive to Princeton office and data and listen to Dave and Matt and their podcast. And not only were what they saying sounded like it was 20 years ahead of its time, but the way they were saying it, they had a vibe that was, everything about it was like, this is where I want to go and want to be. So I definitely give Dave and Matt and the Index Universe people a lot of credit for seeing early what was going to happen. And so in Bloomberg, I was really early, but these guys were earlier. And so for about 10 years, I was just basically learning everything about ETFs, writing about them, doing TV hits, and then ultimately I got hired by research to lead up the research efforts, and that's where I'm at now. So lately, we've been seeing all kinds of innovation. I mean, everything that you can think of. I mean, one of our big themes is the more passive takes over the core, the more creative new ETF launches will become. So these things can be either, because you got to really bring it to displace a cheap passive ETF, or you can complement it by doing something really interesting or providing a solution. So to me, that's where all the innovation's going now is, can you get cheap and value-oriented enough to displace a Vanguard fund? That's what Avantis and Capital Group and those guys are doing with cheap active, or Smart Beta does that. Or can you deliver something that I can put on top of that boring vanilla portfolio that gives me some gets my blood flowing or provides a solution or something very interesting to me. And I think that's ultimately, that bifurcation is what we're seeing now. But again, there's been a ton of evolution up until this point.
Yeah, Dave, I mean, your career, I mean, how have ETFs evolved? Like, how have you seen, what has surprised you about that? And then wearing your futurist hat, where are we heading?
I won't make a long story longer, but you know, in the beginning, you know, back in '87, which is when I first started thinking about ETFs before they existed, because I lost what little money I had in the crash, I followed with some attention what was going on with the portfolio insurance scandals and crises and the SEC's response, which is what set up Canada to launch the first ETFs. And then we caught on, and at that point I was working at what was Barclays Global Investors, which became BlackRock iShares, and so started working on the first entries there, which were the Webb's products, which I was absolutely sure would fail. I did not understand how these things were ever going to work, because if you think about it, before there were any ETFs, there was an incredible chicken and egg problem, which still exists for y'all today every time you launch a new product, which is somebody has to put money in it, and then somebody has to trade it, or you don't have a product, but nobody will trade it or put money in it unless you have a product. And that chicken and egg problem seemed really intractable in the mid-90s. And it wasn't until a couple of large institutions really started using it for cash equitization, or really for international exposure, which is what we were focused on because of the settlement issues. So it was solving a capital markets problem with a level of efficiency you couldn't do anywhere else. And I would argue that has been the story of ETFs, becoming the local optimum of efficiency in capital markets. And I think we've reached the point now with the passage of 6011 and a lot of sort of opening up of other asset classes where I think you can say ETFs are in fact the local optimum for capitalism, period, right? If you want to move capital around the global economy, ETFs are the most efficient way we figured out how to do it. And that's really interesting, and I also think that's actually really important, right? If you care about solving big problems, you need big power, and big power means big money. It's got to be ETFs. In terms of where we're going forward from here, I think it's obvious to say that all the easy stuff's gone, like you said, unless you're going to compete with Vanguard on distribution or cost somehow. So I think my note right here says the next 10 years are going to be lit. That's what I wrote. Because everything that's going to be interesting in ETFs is going to be one of two things, either a packaged trade or a packaged portfolio. That's the open field right now. That's a pretty big open field that's basically infinite. But we're seeing that around the world, not just in the US, in other markets like Canada in particular, a lot of focus on portfolio ETFs, single ticker solutions that include mixes somehow of multiple asset classes that are designed to be that one line item solution. In the US, we hate that. That's very anathema to a US investor. Instead, what we're doing is packaging trades like crazy. I mean, we've now got zero data expiration spins on the queues, right? We're going to package trades narrower and tighter and wilder and crazier than we've ever seen before. And a lot of those things are going to close, and some of them are going to be brilliant, and people are going to make tons of money on them. Yeah. But I think that's really exciting. The base is baked, and now we get all the interesting stuff.
Yeah. But it's interesting, though, going back to kind of this idea of what became ETFs, but needing that institutional buy-in. And then you kind of had that and you started to get traction. And then there became this misconception that ETFs were like a retail product and institutions didn't use them, right? But you'd look at the holdings and the majority of holders were, 50% plus were at least financial intermediary driven. But now you're seeing, Paul, you guys have been great adopters of ETFs and new ETFs. How do you guys think about ETFs? How have you kind of gotten to the part in your portfolio where, from a holistic looking at your investments and the options that you guys have, you're a huge institution. Why are you guys using and how are you using them?
Yeah, we started using ETFs in 2019. At the time, we were implementing a new asset allocation strategy that we call our valuation-based asset allocation. So we were kind of moving away from a traditional strategic asset allocation that you see at most institutions, more towards a dynamic asset allocation where we tilt the portfolio based on asset class valuations. We started implementing that in the middle of 2019. We kind of knew that we would need either futures or ETFs to implement that, low cost passive vehicles that we could trade easily. We weren't really sure at the time, which, would we be using more futures or ETFs? But ultimately, early in 2020, the COVID crisis hit, and we traded essentially 100% of our fixed income portfolio, turned the entire thing over. We were overweight U.S. Treasuries, short duration cash at the time, and when spreads blew out in high yield and emerging market debt, people are kind of familiar probably with what happened in the middle of March. You couldn't trade corporate bonds, could barely trade anything in fixed income, but you could trade ETFs, and they were, even though they were trading at a significant discount to NAV, we were buying them, high yield ETFs at spreads of 1,000 basis points, emerging market debt ETFs, and then we kind of never looked back from there. We continued trading the portfolio with ETFs. And
how big are we talking here? Because that sounds like an impressive feat if it's billions and nothing if it's a penny. So
we traded close to $3 billion in fixed income ETFs in February, March, and April 2020. Our total portfolio was at the time about $11 billion. And then we traded probably close to $1.5 billion in equity ETFs too. We were also buying equities, sort of at the end of March as well.
But I thought that when everyone decided to sell ETFs, then ETFs were going to break the market. So that didn't happen.
Yeah, and I think ETFs kind of proved themselves. We were able to trade them, and we did pretty well in the first and second quarter of 2020.
Did anything surprise you? Did you have any hiccups or anything that you thought?
I think I was kind of surprised at the trade sizes we were able to put on in ETFs, considering the fact that we did have a couple traditional core fixed income managers at the time that owned corporate bonds, and they basically told us, you can't sell them, but we were able to trade the ETFs. So we were kind of surprised at how much we were able to do.
It's interesting, the two guys who invented the ETF, Nate Most and Stephen Bloom, who worked at the American Stock Exchange sort of across the street, down the street, their whole reason for doing it, and they work with the SEC a little bit, was to have some kind of a release valve in a crisis that provided liquidity. So it's interesting to hear that their dreams have come true. Nate Most is no longer with us. Steve Bloom is sort of a professor who isn't in the industry anymore. He's hard to reach, but certainly that's interesting that it totally worked out that way. And again, I think Dave and I have seen so many people with these some worry articles about, especially bond ETFs, that there's a liquidity mismatch, but they seem to work well. Again, they're just receipts, and the receipts are connected to something that's physically held for you. So that's why I think they corrected the portfolio insurance, which used futures. And so they evolved that in a way. They kind of are the best of both worlds in terms of futures or a mutual fund. They're kind of a combination of both of the benefits of either of those.
But the irony, to your point, is that from 1993, the launch of SPY, through probably after the dot-com crisis and into 2002, I would say, institutions were the only people trading ETFs.
Yeah.
So we had this huge shift in the early 2000s where all of a sudden advisors and retail kind of took over, and people forgot that these things came out of the institutional market.
Yeah, I mean, Amex just wanted more volume. They were in third place. They didn't care if you advisors, they just wanted people to trade them. So they were going after institutions. I believe it was a Japan institution that was the crucial first investor in SPY that kind of got it off the ground. SPY was a dud. It had nothing going on for like 8 months to a year. They almost closed it. But they got, I want to say, I can't remember who it was. They got somebody in Japan that was a big pension to buy in. That kind of kept them afloat, and then they sort of finally got it going. But I think it was Barclays that saw the retail, the potential for ETFs. But for the first couple of years with Webbs and MDY and Diamonds, they were really an institutional trading tool. They were simply futures, but backed by something, right? And so that's what Amex thought. But I will say, and that's where I give credit to Vanguard or Bogle, is that SPY launched at 20 basis points. This is crucial because, and they launched the 20 basis points because the Vanguard 500 index fund was 20 basis points at the time. That started ETFs out on third base in terms of getting to retail. Had they priced it at 80 or 90, they still could have gotten traders, but it probably wouldn't have been it would have been slower at least getting into the advisor world and retail world. But so the Vanguard effect hit ETFs from day one, and that I think made it easier to see the retail potential.
So Paul, you guys have been very visible in your usage of ETFs, and there's a handful of other traditional institutions, pensions, et cetera, that have utilized ETFs. But it doesn't seem like every institution is using them. When you talk to some of your peers at other institutions, how do you talk about ETFs? How are they viewing ETFs?
Yeah, I mean, I think there's you sort of have to decide, like a lot of pension funds or institutions have internal management teams that trade traditional bonds and equities, and then there's some funds that are just purely external manager focused. So ETFs kind of lie in the middle. In past years we had both internally managed fixed income portfolios that I was managing, and then external management. So we were sort of comfortable with that gray area and comfortable taking on the sort of price risk of which ETF you buy, the risk of that you encounter trading ETFs. But I think that's one of the main challenges. It just they don't easily fit in an internal or external management box.
Do you see that changing or evolving at all?
Yeah, I think on the internal management side, people are using them to supplement their fixed income portfolios. Get investment grade credit exposure. ETFs are just a lot easier to trade than trading a basket of 100 individual corporate bonds.
Eric, you literally wrote the book on it. How have you seen institutional usership evolved, and where do you think it's heading now?
Yeah, this is refreshing to hear, because when I dove into how institutions use ETFs, I called endowments, pensions, hedge funds, and honestly, a lot of the CIOs were like, well, I use ETFs in my personal account, but I would never use it for the fund. And I'm like, and so that was interesting. In fact, when I have institutional usages listed in the book, I have personal usage as one of them. But a lot of institutions, what they really love in ETFs that they can't get anywhere else, because big institutions, if you're a giant pension or endowment, BlackRock or whoever will roll out the red carpet for you. You can get whatever you want for like 2 basis points, even cheaper than the ETF, and it's exclusive, and you get that feeling of exclusivity. And they like that. I think some institutions are a little, I hate to say it, but elitist, and they see the ETF as the public pool down the street. I'd rather go to my pool in the backyard that was built for me by BlackRock, even though maybe the ETF, like a Simplify, this company could be a hedge fund, totally, but they happen to sell ETFs. So I think you have to get over yourself a little bit sometimes as institutions, see the value here. But the one thing they could never replicate anywhere else is liquidity. So you just talked about it. In 2008, that's the year that made ETFs. That's when the flows really started to go off, and the volume. Because that's the year where a lot of active managers did worse than the index, and a lot of retail were like, I'm done. I'm going to the ETF, it's over. And that's the year where institutions saw that ETFs had liquidity when nothing else did. So to me, 2008, and that's why in crisis after crisis, they get new audience members, they get new fans, new users, in the institutional and the retail world. And so over time, I think institutions will use them for cash equitization, manager transitions, as adjustment mechanisms, portfolio completion. GLD is used a lot. A lot of holders of GLD are institutions. But when you get to funds that, I don't know, might have a really good investment solution but aren't like totally liquid yet, that's when you tend to see mostly RIA adoption. But as they get more liquid, that's when the institutions start to like come around. I think they also don't want to be like too big of a market when they buy it, even though you could totally do a creation. There's a whole nother problem with institutional adoption. They still look at volume as all the liquidity when there is implied liquidity. So I think institutions honestly have the most to learn in terms of utilizing ETFs versus I think advisors are more advanced.
Do you think we're past the era where institutions are working with BlackRock to take their SMAs and turn them into the new flavor of the month? I mean, we saw that maybe 6-7 years ago. We had a rash of those, particularly around ESG stuff. There was some around smart beta. Remember, some of those early smart beta funds were direct transfers for BlackRock. Has that mostly abated? Like, have all those little flavors of the month for institutions already been ETF-ified?
You mean the bespoke products?
Yeah.
That's Matt's term for when an institution calls up BlackRock and said, let's make an ETF. That's how she got started. The fearless girl out front, that was a bespoke product from, I think, CalSTRS.
Yep.
Yeah. So a lot of institutions will call up BlackRock, and instead of doing, say, let's do a separate account, they'll say, let's make an ETF, and we'll be the anchor tenant. That's what happened with some ESG ETFs recently with a Finnish pension fund. And we've seen that, but it's few and far between, I think. I think ultimately those are rare cases. Whereas an ETF that gets into that like deep liquidity status, there's about 50 ETFs that we will call pseudo futures. They're so liquid, they're like the futures market. Those are where I think you tend to see most of the institutional adoption. I think that's the gateway usage right there, where they then explore more and go, this actually works pretty good. But I'd like to throw something over to you, which is that one of the challenges for institutions that I found when I researched my book is the fear of failure. Because if you assemble a portfolio of ETFs and you're the CIO, well, the board could be like, well, this didn't exactly work out exactly as we thought, and then the CIO is under the gun. Whereas if you hire a consultant, then the consultant hires active managers. The CIO can always say, well, it's the consultant's fault. And the consultant can say, well, it's the active manager's fault. We'll fire them, hire this other one. And so everybody can keep their jobs. And so I think—
the active manager.
Except, well, yeah, they come and go. So there's a conflict of interest in terms of just the structure of an institution and the maybe fear of a CIO kind of saying, actually, I'll run this, and I'll use ETFs, I'll use a little active, a little passive. That was one of the things, is that CIO is like a fall guy, if you know what I mean. And that was a big thing I heard when I talked to people. Not to mention the other one was that feeling of exclusivity. You go to a cocktail party, talk to other CIOs, oh, I'm in the new hedge fund, I'm in the new private equity. That also made them like feel like really good about themselves.
Yeah, I think the point you hit on about institutions taking on risk is kind of the biggest factor, and we're actually comfortable taking on that risk. We talk to our board about our investment strategies, on a pretty frequent basis, and they're very familiar with what we're doing in ETFs. We have had quite a bit of success, especially in our fixed income portfolio with ETFs. So that sort of track record kind of helps to build credibility. We're also fortunate, I think, we don't have a general consultant, so that we can be a little bit more creative. We have a very supportive governance structure as well, and our CIO, Jeb Burns, has been very supportive of what we're doing in ETFs. So it's kind of multiple layers of governance, and a team that has the experience and basically willingness to take on some of that internal risk.
Did you guys used to have a consultant, or have you always been set up?
We've never had a general consultant. We use them in certain parts of the portfolio, but not not at the total portfolio level.
Do you get harassed constantly by ETF issuers trying to sell you their?
We do, yeah.
Yeah, you're a big fish.
So what's that process like? I mean, how do you evaluate a new product that's coming onto your desk for the first time?
I follow you guys on Twitter.
Oh my God!
Oh God,
when there's a new following, I look, or a new a new ETF coming out, we look into it. I mean, we kind of know what market exposures we want, specifically in fixed income. So that kind of makes it easy. If there's a new ETF coming out that kind of lines up with some of our market views, then it gets more interesting to us.
And when a new one comes out, like say from a Simplify, where you're like, wow, they really designed this exactly how I want, I love it. Do you know how to use implied liquidity? Because I did look at your portfolio. You're in some stuff that isn't majorly liquid. Like it's not, I mean, it has liquidity, but it's not like GLD liquid. Are you able to understand how to work with the market maker or even do a creation for yourself?
Yeah, we're very comfortable with that. And obviously one of the key variables in liquidity is average daily volume. But in ETFs, what really is most important is the liquidity of the underlying. So ETFs with that own futures contracts that are, trade billions of dollars of notional a day. The ETF might not trade that much, but we're able to get best execution just because the underlying is very liquid. The market makers can use the create redeem process to get us the best pricing.
And when did that concept hit you? Because a lot of a lot of people still don't get that.
I think we kind of started like back in 2019. That was one of the key questions that we had, and got very comfortable just talking to some of the main ETF issuers with how trading works. That was kind of the biggest hurdle that we experienced, was just getting comfortable trading and working with different banks and market makers. But ultimately we kind of got thrown into the fire in 2020 and got a lot of experience doing that, and really never looked back.
I mean, it really is amazing, and you can look it up on Bloomberg, when large institutions, they can triple, quadruple an ETF and do it within bid ask, and you just see the tape pop, and it really is incredible. It's one of the great features of ETFs.
Yeah, sometimes the assets will go up threefold in a day, and just one investor who just basically did like a couple creations, and there you go.
Yeah. Dave, are there any potential drawbacks, any cons to larger institutional players coming to the ETF market?
I mean, I wouldn't say it's a con of their participation, but I do think it's important to point out that ETFs now serve a lot of different masters. And the products that you're using to get sort of institutional quality beta exposure to fixed income allocations is very different than the zero data expiration options ETF that launched last week. So and that's fine. I'm not suggesting one shouldn't exist, but they really are very different markets with very different audiences and very different things you should care about as an investor, right? I mean, if you're an institution trading billions of dollars, you have very different concerns than a mom and pop who's taken a flyer on on oil futures because you got really excited about energy last week. That disconnect between the sophistication of the investor and the sophistication of the product, I think, can become more problematic as we get more and more and more ETFs launching. Like I said, I expect every new ETF to either be a trade or a portfolio at this point. Those trades are probably going to be pretty interesting to a class of retail trader, but probably more to hedge funds and institutions generally. The portfolios are going to be largely skewed towards RIAs, trying to fit into people's models. That may not necessarily be the right point solution for an individual investor either. So managing that sort of the diaspora of ideas in ETFs, I think, can be a little bit problematic. I mean, it means we'll have jobs forever because
that's what makes it fun. I like the big tentness of it all. I love looking at a 485 POS, which is a new ETF filing, and you never know what you're going to get. It's like a Cracker Jack box. Yeah, so I agree. Trading tools are a big part of the ETF world, and if you look up an ETF like TQQQ, only about 7-8% of the holders are people who have to file a 13F, meaning it's all retail, right? So the crazier the ETF, the more retail it's probably, it's geared towards retail. You probably would not use a triple leverage Q. Yeah, it's not, institutions they're probably, I don't know, too smart for that, but you might use it in your personal account though, right?
No, I wouldn't.
No, not even that? Okay, okay. I think everybody's personal account has a little room for partying. I call it hot sauce.
Yeah.
And I think, there is a viable lane for hot sauce out there, and single stock ETFs have provided that, leveraged, thematic ETFs,
the new Tesla
ARC.
trade.
Yeah, the Tesla one. These guys have one that's going to try to use Tesla and leverage around it in order to beat Tesla, the stock, which, again, he said package trades. I always have this phrase, packaged adrenaline. If you can package adrenaline and get it out there, and I'm fine with it. Those funds have such a small sliver of the assets, and they typically have high volume turnover, meaning people know to trade it a lot. If you had a TQQQ and the volume turnover today was 3%, which is about what a Vanguard ETF is, I'd be worried. That means people are buying and holding it, which you shouldn't do. You should trade trading tools, but the turnover per day is probably like 40%. That means people are trading the crap out of it, which is what you want to see. So that said, those, I call them the exotics. They're probably 5-10% of the market in volume, and maybe even a little less in assets.
80% of my inbound emails from people.
80% of what we write about, yeah. It's 80% of the media coverage. I used to have this fun thing that it's like it's my E equals MC squared of my analysis. I tapped into something here. I hope I described this right. It has a pie chart. It says things that make up the core of your portfolio, 95%. Oh, I forgot. I can't describe it. Anyway, the point is that things that make up 5% of your portfolio make up 95% of the media coverage, and vice versa. Like if you do a news search on VTI or something like that, which is the third biggest ETF, takes in tons of money, like nobody writes about it. But then you do a search.
To say?
I know. What can you say?
So you can't write a headline against the total market fund.
So the media skews big time to the hot sauce bucket. And but again, this is the new gadgets that come out. This is the stuff we spend a lot of our time on, because what can you really say about some of the stuff that's in the core?
Then what is not hot sauce, not boring beta, but somewhere in between that's interesting and getting good traction?
So I would put smart beta in there. I would put package trades in there. I would put things that are designed to generate income for you. Advisors have a lot of clients with a lot of different needs, right? And we talked about this earlier. Nervous boomers. is a whole gigantic category to serve. You know, the term boomer candy, which I love that term, boomer candy. There is a market for boomer candy, which is, again, boomers have all the money, right? But they're older and they're nervous because they've made all this money. They don't want to lose it. So that's why the buffered ETFs are one of area that I didn't think would get traction. But the idea of making this sort of structured product that like guarantees sort of your outcome, they're eating it up. And if you talk to an
boomer crack.
Boomer.
No, I mean, seriously, the advisors I talked to, I've talked to advisors, I will not name names, who have said, I don't actually like these products. I have so many customers who have effectively demanded them that I've gotten comfortable with this set of them and this is how I use them. But those have been pull products for most advisors.
Well, I will defend them a little bit in that if you looked at the 60-40, both the 60 and the 40 went down in 2022. That's a scary concept. So a simple diversification with stocks and bonds may not work to protect your nest egg. Therefore, there's a huge lane open for alternatives or buffers or, again, anything that can satiate the boomer's nerves. And so I think you're going to see a lot of people working in that area. The buffered ETFs now have 6-7 issuers that copycatted them, including BlackRock. So that's a whole new category formed. So again, I think we'll see those kind of areas thrive. And smart beta, even though we don't talk about it anymore, it used to be like every panel was a smart beta debate about 7-8 years ago. Then it turned to ESG. But smart beta is big. 1.7 trillion of the 7 trillion of ETFs. That's a big, gigantic niche that was able to carve out. You know, they'll go and tilt into value, tilt into growth, do some dividends, maybe multi-factor. I know you like multi-factor. This is still a very viable way to do a little bit of active at maybe a lower fee. So there's plenty of categories, I think, that are thriving that aren't totally hot sauce or cheap beta.
I think we have to I'd like to put one word of caution on this, though, which is there are impacts from these shifting of risk around the market. And we've seen this. Volmageddon was one. I mean, Mike Green works for y'all. He's written more about it than anybody and probably knows more about it than anybody. But I worry, and I don't have evidence, but I worry that we're continuing to see more and more people selling volatility to generate income. And that does eventually have perturbation effects on the markets themselves, right? You can't get rid of these risks. All you can do is move them around. And I worry sometimes that we are loading up corners of the market, like, say, options dealers' books, with risks that they're not necessarily used to taking in the volume and in the velocity with which they're being moved around, in some part because of ETFs. So
that's fair.
There are downstream implications, which mostly I just think means we need to pay attention.
The other side of that is you've seen a huge rise in options usage across the market, right? So maybe this is just the right equilibrium where there's that hefty premium that's able to be harvested, and the market finds its balance.
Yeah, I mean, that's what you hope, is that these things get priced effectively, right? That everything settles in, everybody understands, okay, these folks are taking this risk, they get compensated that way. Those folks are offloading that risk, they have to pay so much. I worry that because it's happening organically, as it almost always does in democratic capitalism, we don't know what we don't know, right? I mean, stuff works until it breaks. And the ETF part of the sheet has gotten very good at not breaking anymore. We solved sort of the last couple hiccups in 2010 in terms of trading. I'm not sure you can say that about every corner of capitalism.
Yeah.
Also, the ETF tends to be a tip of the iceberg of a larger trade amongst everybody. So like when Volmageddon hit, even though XIV got all the attention, there was a lot of people short vol. It was a popular trade because it worked so well for like 5-6 years there. It was like printing money for a while. So, but XIV was where all the focus was. And I agree with you. I do think there's probably a lot more of buffering going on, but just below in other forms, like maybe separate accounts or structured products that aren't an ETF. So again, sometimes ETFs, I think, actually show you where big chunks of the market are moving. They just happen to be the more public. They're obviously they trade on the exchange. There's tickers. They're just so easy to find. But below usually is a bigger trade.
Yep.
And Paul, the institutional space has been huge adopters of alternatives. I don't know what your portion runs, but you hear stats 30, 40, 50% of institutional investments being in alternatives. Do you guys potentially see ETFs as a way to access alternatives? How do you at Mares think about alternatives in general?
Yeah, our alternatives portfolio is mostly private markets, so we're not really in liquid alternatives, but I think that's a space we'll continue to watch. As managed futures products come into the ETF market, I think the ETF vehicle is an interesting way to get some of that exposure. But really right now, most of our alternative exposure again is in the illiquid private markets, private equity, and real assets.
Then, Dave, as a futurist, I mean, where are you seeing alts? What's getting traction?
Tons of interest there from really the advisor community, I would say, is driving a lot of it in the ETF. But if you're the average, shingle hanging RAA that's got a $150 million book of business, you're not getting access to the private funds that he's putting money into. You're not even getting the phone call returned when you try to get into those types of funds. So you're looking for something else. And that's why, frankly, some of your product line, competitors to yours as well, where you're packaging up exposures that institutions are used to thinking of as non-diversified, diversified, non-correlated assets to their portfolio. The ETF has had to be the wrapper these folks use. The bigger challenge is most of the interesting products there tend to either be actively managed or they tend to be complex enough that they don't really fit into anybody's model very cleanly. And with the rise of model portfolios and ETFs, accessing the advisor market with a non-modelable product can be really tricky.
And advisors, I don't think look at stuff like Sharpe ratio. I just think they look at total return. And I think this has been a challenge for the alternative space. If you run a good long short fund and you've got a low vol and a good return, but the return is 3%. It's 3%, but the Sharpe is high. It doesn't eke it out. That's the problem with the Kramer ETF, by the way. It's long short. And so it never has a chance to have that shiny object moment because it offsets too much.
Right.
Where DBMF, which is an alt, I know it's a competitor, but they typically have
frenemies, it's fine.
Yeah, they're frenemies. They have a high inverse correlation to the market. So when the markets are in the gutter, that one's up. And so I think if I was an issuer building alternatives, I would lean towards more heavily inverse correlated funds that shine when everything's darkest, rather than a long short, which is going to be real close to zero all the time, even though it has a high Sharpe. Or you've got to educate advisors on why Sharpe ratio and alternatives matter. Which is, I don't know which is the better move.
I think that you lose the conversational alpha game to, I think, stealing one of your phrases. If you're an advisor and you're trying to convince your client that they should have a 5% slug in something because it's going to return 3% whether the market's up or down 5%, that's a really hard sell.
Yeah, but after last year where the 60-40 got pummeled and that was the old reliable thing, and you've seen bouts of that again this year. I mean, having that diversifier, those non-correlated assets, I mean, what more of a case do you need to be made?
I think that's part of why the buffers serve this purpose, is because they don't drag, they're not dragging when the markets are up. I think that's been tough for advisors is, I have this fund that's down 4%, but the Qs are up 40. And it's like, why do we have this? And I don't know, it's short-sighted thinking, I think. And it's not totally advisable. The clients are short-sighted sometimes. And so I think that's why alts have had a tough time carving out a niche in the ETF space. I do think there's hope, though. Over the next 10 years, it's very possible the market isn't going to return as much as it did the last 10 years. So alts, I think, have an opportunity to do more. I think, though, the challenge is to get advisors to educate their own clients on why alternatives matter. Just like the way an institution understands they matter, advisors should understand that too. But
I think that educating your client thing always sounds great. But I talked to an advisor literally a couple weeks ago up in the Berkshires, and he was telling me about how he talks to his client base and how his year had been going. And he's like, honestly, it doesn't matter what I tell them, I get compared to the S&P 500. And he said, and thank God, because I don't want to get compared to the Qs, because at the time the Qs were up 37%. And he's like, at least they're only comparing the total portfolio to the S&P every day. But that's tough, because no advisor worth the salt is putting his client in 100% US equities. It's the wrong benchmark. But trying to convince a client that the benchmark in their head is wrong, it has always seemed like a losing proposition.
Paul, fortunately, you're not having to deal with that. You don't have to compare everything versus the S&P. And Kelleher, you don't have to compare versus the 60-40. How does Mayors think about building a diversified portfolio? How do you think about incorporating alts into a portfolio?
So our policy benchmark actually is a pure like 65% equity, 35% fixed income. So alternatives, especially illiquid, non-mark-to-market alternatives, like most investors, we benefited from that exposure in 2022, and then that part of the portfolio is sort of lagging this year. But we also have a liquid natural resource portfolio that did really well in 2022. We're getting a lot of that exposure through different natural resource ETFs. So we kind of like that commodity inflation sensitive space. We have about 3% of our total portfolio in liquid natural resources. So that's kind of the one area of sort of the alternative space that we really like. We actually invested in that back in 2020. So it's done pretty well for us over the last 3 years.
Yeah, and the 60-40 allocation and just kind of fixed allocations in general. Mike Green's written a lot about it, and Eric, you wrote the book on Bogle, or wrote a book on Bogle. How do you think about how that influences the market when you have, whether it's retirement accounts or just flows in general, a set amount going into fixed income, a set amount going into equity, no matter what market conditions are? What are the benefits? What are the potential pitfalls of that?
Yeah, Mike and I have debated this extensively, both in public and private. I'm fine with it. I really think that the Vanguard effect is more of a low-cost thing, because the S&P is different than the Qs, and that's different than the Russell, and they're all doing different things, but really the common thread is low cost. And now what might correct it automatically is that active finally is getting cheap. So active ETFs are taking in 25% of the flows this year. They'll make up 5% of the assets. Why? They finally got below 40 bips. And so I think what's going to happen over the next 10 years is that this problem will be rectified to a degree, because active's going to have a comeback. And it's going to have to go through this painful but necessary crucible of getting below 40 basis points, or at least beta adjusting their fees. If you're low tracking error active, the problem is if I see Apple and Microsoft and JP Morgan at the top of your holdings, an advisor thinks, well, I can get all that for free. That's beta. So I only want to get charged for the active. So Avantis and DFA, which are real tight tracking, they are cheap. Whereas ARC, which only has 1% overlap with the S&P, is 75 basis points, but people are okay with that because it's so different. So it's like, just charge me for the active and give me the beta for free. The metaphor I use is a bag of potato chips. You know how there's like all that air in it? I only want to get charged for the chips, not the air. And I think that's ultimately how active is going to come around. And then I think active will be a bigger part of the market in the future. So I think the market will work this out as active sort of gets with the program a little bit. And it's happening right now. That said, over when it comes to my own personal account and investing, I don't really see too much of a problem, because when a company has really bad earnings, their stock goes down. So I like a sniff test. Do stocks move when major events happen in their company? Yeah, they still move up and down. Does that mean that all the monetary robotic flows going into Vanguard provide a little floor on the day when GM gets sold off because of bad earnings? Probably. Maybe GM would have gone down 10% instead of like 12 when it should have gone down because of the passive bid. So I think passive does affect the markets. It's so, in my opinion, on the fringes, I'm okay with it.
I'll give you I'll take the opposite side of that trade a little bit. So yes, I do think active is coming back. I don't think that active's ability to outperform a quantitative market cap weighted index has gotten any better. I think it's gotten worse. And I think what we're going to see is, as active managers realize that if they want to play outside of the SMA world, they have to play in the ETF market. And that means your beta adjusted fee model is what takes hold. I actually think that means we flush even more active managers out of the system, because most of them are going to underperform over 1, 2, 3 years. Some of them may outperform over the long term. Investors don't think that way, and they haven't for a long time. So because of that difficulty in actually beating this behemoth that is the flows-driven passive market right now, while there will be room for active, I actually think we're going to see a lot of those folks come to market and get flushed.
I will just counter that with you, probably, but I think someone going into a DFA fund at 9 basis points, like an advisor, they're not totally looking at performance, believe it or not. If you get cheap enough, you're almost like performance proof. They like DFA, they like what they're doing. Okay, I'll give you 10 years with this. Same with ARK. I'm going to do 2% in ARK. I don't really care that it goes up and down a lot. I kind of buy into Kathy's future. What if there are robots flying around? I don't want to miss out on that. So I'll do a little bit. And then high active share complements my cheap beta. The one counter to that, though, is smart beta. So smart beta took in like 100 billion last year. And smart beta I would consider active. And that's also something where it's allocating based on the merit of the stock, or at least the system. It's not just totally robotic. Even though it's rules-based, it is allocating, like if it's a dividend fund, it looks for the, it leans towards dividends, then it rebalances. So smart beta to me is active, it just happens to use rules. So if you combine smart beta, ESG, thematics, active, if you call all that active, it's pretty big.
Sure.
I think discretionary active, I agree with you, but I still think as they get cheap, they'll do better.
Yep. Paul, how do you guys think about active management? Do you have traditional active managers in your kind of core large cap equity sleeves?
So not in the U.S. No, in U.S. equities we have well, actually in microcap we do have a couple traditional bottom-up active managers. Areas of the market that theoretically are more efficient, active managers can add value. We're looking at Japanese small caps right now, looking at active managers there. That is actually a place where more than 50% of managers in that universe actually do outperform their benchmark. That's pretty rare. When you look at different geographies and market segments. In fixed income, we have an active manager in emerging market debt, but then the rest of the portfolio, we're managing actively with ETFs, sort of dialing up credit risk and high yield, emerging market debt. In rates, we actively manage the duration of the portfolio.
But you're the active manager there.
Yeah, we are. Right. We are sort of as the allocator, the active manager in fixed income, and then we, in certain pockets, use traditional active managers.
And just curious, when you're picking like a microcap manager or Japan small cap, do you want tracking error, or do you rather have low tracking error to just eke out some alpha that is a little bit?
Depending on the area of the market, like in Japan small cap, we want tracking error. We want all the managers we're looking at have 6-7% tracking error.
Okay.
Sort of to get that bang for your buck.
Active share.
That's kind of how we look at it.
But that story of being the active manager on your passive sleeves, that's the story of advisors, right? I mean, most advisors I talk to are either in that camp or they've outsourced that to a model, which is effectively doing that for them if it's a fairly active model. So like that institutional style of management, I think, has permeated the market.
I feel like we can't talk about active management without talking about mutual funds. What's the future of mutual funds?
I mean, they're not going anywhere, right? I mean, again, it's local optimums, right? If you are in a defined contribution plan in the United States regulatory system, the 40 Act registered mutual fund is the local optimum for efficiently delivering on that defined contribution plan. That's an enormous pool of assets, something like $13-14 trillion of mutual fund assets right now are tied to that. That's not going to go anywhere. It's not that it's impossible to then rebuild your 401k with ETFs. There's just no reason to, because you can get pretty much the same exposures and the same packages, the same fees in the traditional mutual fund wrapper, and you don't get the tax efficiency, but you don't care about that in a 401k anyway. So I don't think the mutual fund industry is going away. I do think that very few retail and advised clients are going to be putting their taxable money into mutual funds in 10 years.
Yeah, a lot of the assets are mirage assets.
Yeah.
They're basically, if you had a big base going into the 2000s, if you were a big 80s and 90s mutual fund company, you are so set for life because you can see all the outflows you want, but the market went up 8 times since then. And so the bull market subsidy is so strong, it totally offsets your outflows.
So it's zombie assets.
So yeah, they're rich and they've got a ton of revenue still, but they're almost like a house that there's nothing behind it. They're losing clients.
Well, it's zombies.
It's
right?
It's
it's literally dead money.
Yes.
I've talked to a few mutual fund managers who are actually in a pickle because their investor base is now unreachable. They can't get proxy solicitations returned. And so they can't actually make any changes to their prospectuses because they can't find any of these investors, but they have a few $1 billion of their money.
So I think a lot of them will convert to an ETF or use a share class system or launch clones, but they're going to keep the mutual fund open as a sort of cash cow for a while. And I think mutual funds, they have 26 trillion. If you include money market funds, that's a triple, quadruple ETF still. So we hired a mutual fund analyst, actually, which someone on LinkedIn said, that's like Elon Musk looking for a combustible engineer. But you know, when we write about mutual funds and active, we get a lot of readership on the terminal because that's a lot of our buy-side clients. There's a dearth of people, like all the reporters have moved over to ETFs. Mutual funds are like just sitting there like almost like zombies is a good word. No one covers them, no one cares, but they're still there.
Morningstar cares.
Morningstar, that's true. Morningstar cares. But you know, the action is in ETFs, but mutual funds aren't going anywhere anytime soon.
Then Paul, what are you getting pitched as the next ETFs? Like what disrupts ETFs that you're getting propositioned with, if anything?
Crypto?
No, we kind of tend to like the boring stuff, right? Low cost. We're not going to be the first to jump on something super innovative, I don't think, or popular. We tend to be more contrarian. So.
What about you guys? Is direct indexing a threat to ETFs?
I think direct indexing was a threat to the 50 basis points of the market that it's taken, right? I mean, I think direct indexing is an incredible point solution for people who have the problem set that direct indexing is the point solution for. It's not a panacea. If you talk to advisors that have made really good use of things like Orion's platform or Canvas or things like that, they will tell you that it's like, oh no, we have billions of dollars on these platforms, but we'll never put any more in because the only people they put in there were the ones with giant single stock overload problems or huge tax management problems where the tools of a DI platform really let them go to their client and say, I have a 5-year plan to get you out of your pickle. And for that, there is no substitute for a DI platform except somebody doing a lot of manual work. So for those folks, I think it's been a panacea. For folks that have very specific requirements around ESG, or I cannot own Google for some legal reason or whatever, there is no other alternative. So it's been great for that, but I've never been a believer that it's going to take 25% of the ETF market, any of that.
Yeah, everything he said, I totally agree with. My metaphor right now, current metaphor, it might change, is direct indexing is like the Segway. Remember how it was supposed to revolutionize transportation, and now it's only used by mall cops and city tours? To me, that's direct indexing. Now, separate accounts for institutions, that's $4 trillion, and remember, institutions like that. But there's plenty of customization you can do with ETFs now, plenty. To go to that next level is only going to be for a very few people. And then you get to the tax issue. Again, very ultra high net worth individuals probably will use it. I think advisors may like it because it helps them differentiate from the advisor next door using a couple ETFs.
It's great cocktail party fodder, like you were just saying.
That's
like,
true.
Oh, I'm in a private direct indexing platform that's customized just for me. Now the reality is, how many people in this room really need a customized investment management plan that looks like nobody else is on the planet? Probably nobody.
Yeah, so I would say 2-3% of all the vehicles, mutual funds, ETFs, closed-end funds, I think 2%, 3% market share is probably, but that's a lot of money. Don't get me wrong. I was never bearish of it not carving out a niche. I was more bearish versus some of the hype of how big it would get.
And then to wrap it up, I'm going to go down the line. What within ETFs thematically are you excited about, and what is a dud and just meh, I'm tired of talking about it? If or something that you envision, all right, this is coming, but there's going to be a lot of noise around it, but it's not going to go anywhere.
I will say that the Rubicon we crossed about doing literally zero data expiration strategies in a daily traded vehicle, that starts to cross a few edges of like, oh, now we've got settlement issues, and it's like, when does the blotter actually get registered? Because one of the reasons institutions trade zero data expiration options is they never show up anywhere, right? So like, I worry a little, that doesn't seem like the greatest use case. I suspect those products will catch a little bit of a bid, and then there won't be a flood of them, but I would be concerned if all of a sudden we had a raft of 100 zero data expiration options portfolio-based ETFs.
And then what are you excited about?
What am I excited about? I actually am excited about more portfolio type strategies coming to the US market. I think there are a lot of retail investors who would benefit from single point solution investing. There's a reason target date funds are the default for a lot of investors in their 401k plans. I'm not suggesting we need to replicate that in ETFs. We tried that, they've all closed. But I do think some of what's happening in Canada around creating more thoughtful portfolios that are a little bit more dynamic, I think we'll import some of that in the next 5 years here.
Eric?
Boring.
I mean, okay, I'll give the fun answer. Definitely the Bitcoin ETF. Me and James have been on this like for the last 11 years,
That's just
frankly.
theater at this point.
Yeah, but eventually we'll get a spot Bitcoin ETF. Then there'll be Ether. Then there'll be Ether plus Bitcoin minus Tesla. And then they're going to be like all this different. I just get excited when ETFs knock down a new asset class. They're going to bring price pressure, and they're going to put pressure on these crypto exchanges, which charge a ton of money to trade. Bitcoin ETF will charge 1 basis point. So it's going to be fun watching the ETFs disrupt crypto a little bit. It's going to be interesting because the ETF will act as a bridge to the boomer advisors and this wild, wacky crypto underworld. And there's all kinds of interesting things you can do in there. And again, if it will definitely live in that hot sauce lane, which is a viable lane. So that is going to be a fascinating area going forward.
And Paul, anything you're excited about or meh about?
Yeah, in fixed income ETFs, we like seeing all these new ETFs come online that allow us to get precise exposure. Where we see market opportunities, the more precision is out there, then the more efficiently we can take advantage of different opportunities. So.
All right, well, gentlemen, thank you. This was a wonderful conversation. Thank you, everyone, for joining us.